Well, March natural gas futures continue to edge lower as traders position for the upcoming spring shoulder season. Although forecasts indicate a brief cold shot across parts of the Midwest and East Coast between February 21 and February 25, the market appears to be largely ignoring it. Instead, attention is centered on the warmer pattern expected from February 25 through March 4, which is projected to suppress demand into month-end aside from a short-lived increase during the late February cold spell. After two substantial storage withdrawals of 360 and 249 billion cubic feet, focus is now shifting toward how quickly production can rebuild inventories. As of February 6, natural gas stocks were 130 billion cubic feet below the 5-year seasonal average. This suggests a potential storage deficit heading into shoulder season, but not one that appears unmanageable before summer cooling demand arrives. The current price softness reflects this broader assessment. On the supply side, projections from the Energy Information Administration reinforce the bearish narrative. The agency raised its 2026 U.S. dry natural gas production forecast to 110 billion cubic feet per day, up from the previous estimate of 108.8 billion cubic feet per day. Meanwhile, Baker Hughes reported that active gas rigs increased by 3 in the week ending February 13, bringing the total to 133 rigs, the highest level in 2.5 years. This marks a significant recovery from September 2024, when the rig count had fallen to a multi-year low of 94. The recent weakness also reflects the rapid rebound in output following Winter Storm Fern, which temporarily curtailed production in parts of Texas due to freeze-offs. The speed of that recovery, combined with expectations of softer demand, is weighing on prices and putting pressure on the key psychological $3 level. A sustained move lower could open the path toward the $2.60 area. Meanwhile, sellers still face a significant technical hurdle near the $2.90 level, which continues to act as firm support. A considerable number of bullish traders are closely watching this zone and may be prepared to step back into the market, particularly with several new LNG facilities expected to begin operations later this year. The anticipation of additional export capacity provides an underlying layer of confidence that could limit downside momentum in the near term. From a technical standpoint, this makes a clean and sustained break below $2.90 less probable without a fresh bearish catalyst. However, if bears do manage to force a decisive breakdown beneath that support, downside pressure could accelerate quickly. In that scenario, prices may slide toward the January lows in the $2.70 to $2.60 range. Such a move would effectively fill the price gap back up to $2.90 and completely unwind the 2-week winter storm rally that unfolded in late January, resetting the market to pre-spike levels. Nevertheless, I view this scenario as less probable. As I mentioned earlier, the anticipated growth in LNG exports remains a key bullish driver supporting the market. If you're looking for a more detailed breakdown of the market, consider joining the channel. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.